Let me ask you something. When was the last time you saw gold move like this? Not just up, not just breaking records, but accelerating, building momentum, moving faster each week than it did the week before. Because that's exactly what's happening right now. And if you're not paying attention, you're missing one of the most significant wealth transfers in modern financial history. I'm going to show you something that most people aren't talking about, something that goes way beyond the headlines about new all-time highs. Because yes, gold hit new records. But that's not the story. The story is the velocity, the acceleration, the way this market is starting to move. And when you understand what's driving it, you'll realize we're not at the end of this move. We're at the beginning. Let me take you back to March 2024. Gold was trading around $2,100 an ounce. Respectable, solid, but nothing crazy. Fast forward to today, and we're pushing past $2,800. That's a 33% gain in less than a year. But here's what makes this different from every other gold rally you've seen. It's not retail investors driving this. It's not fear. It's not panic buying. It's central banks. And they're not slowing down. They're speeding up. The World Gold Council just released their Q3 data, and it's staggering. Central banks added 337 tons of gold in the third quarter alone. That's the highest quarterly purchase since they started tracking this data systematically. But here's the kicker. They added 800 tons in the first 9 months of 2024. At this pace, we're looking at over 1,000 tons for the year. To put that in perspective, the entire global gold mining industry produces about 3,000 tons per year. Central banks are absorbing 1/3 of global production. 1/3. And they're doing it quietly, methodically, and without any signs of stopping. Now, you might be thinking, okay, central banks are buying gold. They always buy gold. But that's not true. For decades, central banks were net sellers. From 1980 through 2009, they dumped gold. They thought it was a barbarous relic. They believed the dollar was all they needed. Something changed in 2010. They became net buyers. And every year since, they've bought more. But 2022 was when things shifted into a different gear. That year, they bought 1,082 tons, the highest annual purchase in over 50 years. Then 2023, they bought 1,037 tons. And now 2024 is on track to match or exceed those numbers. This isn't a trend. This is a structural shift in how the world's monetary system operates. Let me tell you who's leading this charge. China, Turkey, India, Poland, Singapore, the Czech Republic. These aren't random countries. These are nations that are actively, deliberately, systematically reducing their dependence on the US dollar. China's official gold reserves stand at about 2,264 tons. But here's what everyone in the gold market knows. That number is fiction. China doesn't report their purchases in real time. They update their official figures sporadically, in chunks, often months or years after the actual purchases. Analysts estimate China's real gold holdings could be anywhere from 4,000 to 6,000 tons, maybe more. Why does China hide their gold purchases? Because if the market knew the true scale of their accumulation, gold would be $4,000 an ounce already. They're buying as much as they can before the price runs away from them. And it's not just China. Turkey has increased their gold reserves by over 300 tons in the last 2 years. Poland added 130 tons. Singapore, a country that historically held almost no gold, now holds over 200 tons. The Czech Republic just announced they're doubling their gold reserves. These countries are preparing for something. And that something is a world where the dollar is no longer the undisputed king of global finance. Now, let's talk about what's happening in the actual gold market. Because this is where things get really interesting. The COMEX, the major futures exchange where gold is traded in New York, is showing signs of stress. Registered gold, the gold that's actually available for delivery, has been declining. We're talking about roughly 400,000 ounces of registered gold backing a market with open interest representing millions of ounces. What does that mean in plain English? It means there are far more paper claims on gold than there is actual physical gold to deliver. It's a fractional reserve system. And it works fine until everyone wants their gold at the same time. We saw a glimpse of this in March 2020. During the COVID panic, the COMEX gold futures market nearly broke. The spread between futures prices and physical prices blew out to over $70 an ounce. Normally, that spread is a few dollars. Suddenly, people who owned paper gold couldn't get physical gold. Refineries were shut down, transport was disrupted, and the market seized up. They fixed it temporarily by flying physical gold from London to New York on chartered planes. But the underlying problem never went away. There's still way more paper gold than physical gold, and as central banks keep buying physical, that imbalance gets worse. Here's another piece of the puzzle: the Shanghai Gold Exchange. This is where physical gold trades in China, and it operates completely differently from the COMEX. In Shanghai, every transaction requires physical delivery. No fractional reserve, no paper games. Real gold changes hands, and for the last 2 years, gold has been trading at a premium in Shanghai compared to London and New York. Sometimes $20 an ounce higher, sometimes $40. That premium tells you something critical. There's more demand for physical gold in Asia than there is supply. China isn't just buying gold for their central bank. Chinese citizens are buying gold. In 2023, Chinese gold demand hit 1,089 tons. That's jewelry, bars, coins, everything. It's the highest level in years, and it's not slowing down. Why? Because the Chinese economy is struggling. Property values are collapsing. The stock market is volatile. The yuan is under pressure. And Chinese citizens, who are some of the most gold-oriented people in the world culturally, are moving their wealth into the one asset they trust: gold. Now let's zoom out and talk about what's driving this at a macro level. Because it's not just about central banks in China. It's about the entire global financial system reaching a breaking point. The United States has $36 trillion in national debt. Let me say that again. $36 trillion. We're adding $1 trillion to that debt every 100 days. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense. More than we spend on Medicare. How do you service that debt? You print money. You keep interest rates low. You inflate the problem away. And when you do that, you destroy the value of the currency. Every country watching this knows what's coming. They've seen this movie before. Weimar Germany, Zimbabwe, Argentina, Venezuela. When governments can't control their spending, they print. And when they print, the currency dies. That's why central banks are buying gold. They're not buying it because they think it's going to $3,000 or $4,000 or $5,000. They're buying it because they know the dollar-based system is unsustainable. And when it breaks, gold is the only asset that will hold value. Let me give you a historical parallel. In 1971, Richard Nixon closed the gold window. He ended the convertibility of dollars into gold. Why? Because foreign central banks were draining U.S. gold reserves. France, under Charles de Gaulle, was converting dollars into gold as fast as they could. They didn't trust the dollar. They wanted real money. Nixon had a choice: either let the gold reserves go to zero or end the convertibility. He chose to end it. And overnight, the world moved to a pure fiat currency system, a system based entirely on trust. Trust that the U.S. would manage the dollar responsibly. For 50 years, that trust held. But it's breaking now. Not because of one event, but because of 1,000 small cuts. The 2008 financial crisis, the COVID money printing, the weaponization of the dollar through sanctions, the freezing of Russia's dollar reserves, the endless deficits. Countries are looking at that and thinking, if they can freeze Russia's reserves, they can freeze ours. If they can print trillions without consequences, the dollar isn't safe. And so they're buying gold, because gold can't be printed. Gold can't be frozen. Gold can't be sanctioned. Gold is the ultimate neutral reserve asset. Now, here's where this gets personal for you, because this isn't just a story about central banks and geopolitics. This is about your wealth, your retirement, your purchasing power. If you're holding dollars or assets denominated in dollars, you're on the wrong side of this trade. The dollar might not collapse tomorrow. It might not collapse next year. But the trajectory is clear. The dollar is losing its status as the world's reserve currency. And when that happens, everything priced in dollars is going to reprice violently. Think about what you own: your savings account, your bonds, your 401k filled with stocks that are priced in dollars. If the dollar loses 20% of its value, you just lost 20% of your wealth. Even if the stock market goes up, if it goes up in a currency that's falling, you're not actually getting ahead. Gold is the hedge against that. It's not about making a quick profit. It's about preserving what you've already built. And here's the thing. We're still early. I know that sounds crazy when gold is at all-time highs, but look at gold as a percentage of global financial assets. It's less than 1%. Less than 1% of all the wealth in the world is in gold. In the 1980s, it was over 5%. In the 1930s and 40s, it was over 20%. If gold just reverts to its historical average as a percentage of global wealth, We're talking about $5,000, $6,000, maybe $10,000 an ounce. And that's not some wild prediction. That's just math. But here's what most people don't understand. Gold doesn't move in a straight line. It moves in waves. Long periods of consolidation, followed by explosive moves higher. We saw this in the 1970s. Gold went from $35 an ounce in 1971 to $200 by 1974. Then it consolidated for 4 years. Then it exploded to $850 by 1980. We saw it again in the 2000s. Gold went from $250 in 2001 to $1,000 by 2008. Then it pulled back during the financial crisis. Then it exploded to $1,900 by 2011. Right now, we're in the early stages of the next explosive wave. Gold broke out of a decade-long consolidation in 2020. It's been building momentum ever since. And the acceleration we're seeing now, this is the market telling you something big is coming. Let me tell you about the silver market. Because if you think gold is interesting, silver is absolutely wild. Silver is trading around $32 an ounce right now. That's up significantly from where it was a year ago. But here's the thing about silver. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting around 85 to 1. Historically, that ratio averages around 60 to 1. In Roman times, it was 12 to 1. Even in the modern era, it's been as low as 30 to 1. Right now, at 85 to 1, silver is cheap relative to gold. But silver isn't just a monetary metal. It's an industrial metal. It's used in solar panels, electronics, batteries, medical equipment, and here's the kicker. We're running out of it. Global silver production peaked in 2016. We've been in a supply deficit for 3 consecutive years, meaning we're consuming more silver than we're mining. Where's the extra silver coming from? Above-ground stockpiles, recycling. But those sources are finite. At some point, the market is going to wake up to the fact that there isn't enough silver to meet demand. And when that happens, the price is going to move fast. I'm talking about silver potentially hitting $50, $75, maybe $100 an ounce in the next few years. And if you think that sounds crazy, remember that silver hit $50 in 1980 and again in 2011. It's done it before. It'll do it again. Now, let me pause here for a second, because if you're sitting on $100,000 or more in retirement accounts, there's something you should know. You can actually hold physical gold and silver inside a retirement account. It's called a gold IRA. I put together a free guide that explains exactly how it works, how to roll over funds from your existing 401k or IRA without triggering taxes or penalties, and what you need to know before you do it. It's in the description below. No pressure, but if you're thinking about protecting your retirement with precious metals, it's worth a look. All right, back to what's happening in the market right now. One of the most fascinating developments is what's happening with gold mining stocks. Normally, when gold goes up, mining stocks go up even more. It's leverage. If it costs a company $1,200 an ounce to mine gold, and gold is selling for $2,000, they're making $800 per ounce in profit. If gold goes to $2,500, they're now making $1,300 per ounce. Their profit margins explode. But right now, gold mining stocks are lagging. The major gold miners are up, but not nearly as much as gold itself. Why? Because investors don't trust this rally yet. They think it's going to reverse. They think gold is going to pull back. That's actually a bullish sign. Because when investors finally realize this rally is real, when they finally start piling into mining stocks, that's when you'll see the real fireworks. We're talking about mining stocks potentially doubling or tripling from here. And it's not just about the big miners, the junior mining companies, the ones exploring for new deposits. Those are the real leverage plays. A junior miner with a promising gold discovery can go up 10 times, 20 times, even 50 times if they hit a major deposit. It's risky, absolutely. But if you know what you're looking for, the potential returns are staggering. Let me tell you about what's happening with gold ETFs, because this is another piece of the puzzle. The big gold ETFs like GLD and IAU have been seeing outflows for most of 2024, meaning investors have been selling their shares. And yet, gold keeps going up. How is that possible? Because the ETF outflows are tiny compared to the central bank inflows. Western investors are selling, Eastern central banks are buying, and the central banks are winning. But here's what's going to happen. At some point, Western investors are going to wake up. They're going to see gold at $3,000, $3,500, $4,000. They're going to see their friends making money. They're going to see the headlines. and they're going to panic buy. When that happens, when retail investors flood back into gold, that's when this market goes parabolic. We're talking about gold potentially moving $500 or $1,000 in a matter of months. It's happened before. It'll happen again. Now, let's talk about the geopolitical situation, because you can't understand the gold market without understanding what's happening in the world. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based financial system. They're setting up currency swap agreements. They're trading in their own currencies. They're building payment systems that bypass SWIFT, the Western-dominated financial messaging system. At the last BRICS summit, they discussed creating a gold-backed currency for international trade. Now, that's a long way from reality. There are huge logistical and political challenges. But the fact that they're even discussing it tells you where this is headed. Russia, after being cut off from the dollar system, has been settling trade with China, India, and other countries in rubles, yuan, and even gold. They're proving that you can operate outside the dollar system, and other countries are watching. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales to China. That's a massive shift. For 50 years, oil was only sold in dollars. That's what gave the dollar its reserve currency status. If that system breaks down, the dollar loses its primary source of global demand. And when the dollar loses demand, it loses value. And when the dollar loses value, gold goes up. Here's another angle most people aren't thinking about. The U.S. government holds about 8,100 tons of gold. That's the largest official gold reserve in the world. At current prices, that's worth around $700 billion. Sounds like a lot, right? But compare that to the $36 trillion in debt. The U.S. gold reserves represent less than 2% of the national debt. In other words, even if the U.S. sold all its gold, it would barely make a dent in the debt. But here's the interesting part. If gold goes to $10,000 an ounce, those reserves are suddenly worth $2.6 trillion. If gold goes to $20,000, they're worth $5.2 trillion. At some point, the U.S. government might decide to revalue gold higher, not because they want to, but because they have to. Because it's the only way to make the math work. That's what happened in 1934. Roosevelt revalued gold from $20.67 an ounce to $35 an ounce overnight, a 69% increase. Why? Because the government needed to inflate the money supply to fight the Depression, and the gold standard was limiting their ability to print. Could they do it again? Absolutely. And if they do, anyone holding physical gold is going to wake up significantly richer. Let me give you another historical example. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's about $3,200 in today's dollars. We're not there yet, but we're getting close. And here's the thing. The fundamentals today are far more bullish than they were in 1980. In 1980, interest rates were at 20%. Paul Volcker, the Fed chairman, was crushing inflation by making the dollar incredibly attractive. Today, real interest rates, after accounting for inflation, are barely positive. Sometimes they're negative. The dollar isn't attractive. It's being debased. In 1980, the U.S. was a creditor nation. We had a trade surplus. We were financially strong. Today, we're the largest debtor nation in history. We run massive trade deficits. We're financially weak. In 1980, central banks were selling gold. Today, they're buying it at record levels. Every fundamental indicator suggests gold should be higher today than it was in 1980, even after adjusting for inflation. And yet, we're just now approaching that level, which tells you we have a lot of room to run. Now, I want to talk about something that doesn't get enough attention: the psychology of this market. Because markets aren't just about fundamentals. They're about human emotion, fear, greed, FOMO. Right now, most investors are skeptical of gold. They've been trained to believe that stocks always go up, that the Fed will always save the market, that the dollar is invincible. They think gold is a relic, a pet rock, something your paranoid uncle talks about. But that skepticism is exactly why this rally has legs. Because when the skeptics finally capitulate, when they finally admit they were wrong, that's when the real buying begins. I've been watching the gold market for over 2 decades. I've seen rallies come and go, and I can tell you, this one feels different. The momentum is building. The fundamentals are aligning. The technical charts are breaking out. And most importantly, the smart money, the central banks, the billionaires, the family offices, they're all moving in the same direction. When everyone who understands money is buying gold, you should probably pay attention. Here's what I think happens next. Gold consolidates around current levels for a few weeks, maybe a couple months. It builds energy. Then it breaks through $3,000. Once it clears $3,000, there's not much resistance until $3,500. And from there, it's a straight shot to $4,000. Silver follows with a lag, but when it moves faster. I wouldn't be surprised to see silver at $50 by the end of 2025. And if we get a real mania, $75 or $100 is absolutely on the table. Mining stocks are going to be the big winners in the next phase. Once investors realize this isn't a short-term trade, once they start looking for leverage, they're going to pile into miners. The major producers could double. The junior explorers could go up 10 times or more. But here's the key. You have to position yourself before the crowd figures it out, because once everyone knows, once it's on the front page of every financial publication, once your neighbor is talking about buying gold, it's too late to get the best returns. Right now, we're in that sweet spot. Gold is moving, but most people aren't paying attention. They're distracted by AI stocks and crypto and whatever the latest hype is. They're not looking at the foundation of the financial system cracking beneath their feet. But you're here. You're watching this. You're paying attention. And that gives you an advantage. So what do you do with this information? First, educate yourself. Understand what's happening. Don't just take my word for it. Look at the data. Look at what central banks are doing. Look at the debt levels. Look at the currency debasement. Draw your own conclusions. Second, consider your exposure. How much of your wealth is in dollars? How much is in dollar-denominated assets? If the dollar loses 30% of its value over the next 5 years, how does that affect your retirement, your savings, your lifestyle? Third, take action. Whether it's physical gold and silver, whether it's a gold IRA, whether it's mining stocks, find a way to get exposure to this market. You don't have to go all in. Even 5% or 10% of your portfolio in precious metals can make a massive difference if this plays out the way I think it will. And finally, be patient. This isn't a get-rich-quick scheme. This is a multi-year trend. There will be pullbacks. There will be consolidations. There will be moments where you question whether you made the right decision. But if you understand the fundamentals, if you understand why this is happening, you'll have the conviction to hold through the volatility. Because here's the truth. Gold isn't rising because of some short-term catalyst. It's rising because the entire global financial system is being restructured. The dollar's dominance is ending. Not tomorrow, not next month, but it's ending. And when it does, gold is going to be the asset everyone wishes they owned more of. The acceleration you're seeing right now, this isn't the top. This is the beginning of the vertical phase. This is where decades of monetary mismanagement finally catch up with reality. This is where the bill comes due. And the people who position themselves correctly, the people who saw this coming and acted, they're going to be the ones who preserve and grow their wealth through what's coming next. The question is, are you going to be one of them?